Okay, let's get into this a little bit. Let's get into a little bit of the strategy and how to, do this and set this up. Um, we're on Thinkorswim here. So the first thing we want to do is for the weekly options, we want to identify Monday, which happens to be this candle right here. Today happens to be Wednesday, so when I put in the spread, there's not going to be a lot of premium left because it's already had, 3 days of time decay in it. So what would normally be, you know, anywhere from 15 to a 30-cent spread is, going to be not show up that large, but I'm going to do this for instructional purposes and show you how to set this up and, you know, uh, give you entry and exit criteria. So here's what we did. We go in, and because you're calculating on Monday, because you're going to execute these trades usually about Monday after the high and low of Monday are put in, or you can execute them on Tuesday if you still have some decent premium at the break of the high or low of Monday, because Monday's usually the day that's going to set the tone for the week. I don't know how many people out there know market profile, but I'll stick this in profile terms and regular uh, you know uh, candle logic for you. And so Monday basically is usually a balanced day. It usually has a good, well-rounded Gaussian distribution. Mondays is also a very low news day. There's not a catalyst. So a lot of times, you're just going to get a lot of the short-term traders and scalpers trading on Monday, balancing their accounts out, just for the sake of trading and to set the tone for the week. And by establishing a well-rounded Gaussian distribution, you've got good structure in the market because your news days are usually Tuesday, Wednesday, Thursday, and news days are usually days of catalysts that the larger players are going to be active in the market. So, so usually the market is just going to balance their accounts out on a Monday, so you're going to get like basically, a chop day is what they call it, I guess. But it's really a balanced day. So on a Monday, the break of the high or low is going to set, the tone for the week, and the percentages of it, once you break Monday's high, your trend for the week usually is going to be up, or, if you break the low, it'll be down. So what we've done is we've gone ahead and what we need to calculate are strike prices that are never going to get hit. And this is going to be a little bit different type of trading than the way most options are taught. And most options are taught in with a directional bias. So you're doing you're trying to do like calls for, and predict the direction of the market and try to get this, in the money call to, really move. And it can get pretty hairy and pretty risky. So, what we want to do is we want no risk. We want everything to work in our favor. So what we're going to do is we're going to take Monday's high and Monday's low, which you see here I did, and put them in our spreadsheet. And the spreadsheet's automatically going to calculate the strike price levels for the options. So that's what we've done. And then we went ahead and put, a price line on the numbers here. I picked level 2, kind of medium risk, 195.88, and you can see here 195.88. And then same for the puts. I put 189.09. We have it down here. So just by looking at our chart, there's Monday. So I'm going to set myself up, and I'm going to say the trend is up. So I want to sell a put, a higher price put, and I want to buy a lower price put because I want price to work in my favor. I want theta to work in my favor. I want the delta. I want working in my favor. I want everything I can get to work in my favor. And so the probabilities of this thing hitting the 189.09 by Friday from Monday is minimal. So less than 10%. Actually. And so I want to buy and sell a put. And what I did is I just usually take myself, I just take Monday and I draw right about in the middle. So about 192.50 is going to be my scratch trade. Okay? So take a look a minute here. Really, it can go a lot, farther than that because I'm buying puts at the 189 level. And so you basically have 1, 2, 3, 4, almost a week's worth of 5, 6 days of protection there. And, this is going to protect you against a catastrophic day, a complete sell-off day. If the future's knocked down about 30 points, you're still going to be safe because your strike price is low enough that it should, won't get hit. Okay? So in order to not have the trades move against me, I draw, pretty much a line there, about 50% of Monday, because 50% Monday is usually your point of control. But you can, obviously, the low of Monday, if you're doing puts as your scratch trade, or the high of Monday for calls if you're doing your scratch trade. Because that's what usually happens when the market participants start getting into Monday. They're taking out the structure of the market. It's going to go. So we want to protect ourselves from that. So that's what we've done. We've gone ahead and we've entered Monday's high and low into our spreadsheet. We pressed enter and came up with our strikes. So we've determined our trend is up. So what we want to do is sell a put and buy a put. So let's go ahead and take a look at it. So we're going to pull up our options chain, and we're going to go to the 189 put. And you can see already, this has worked because, the spread on it it's just crushed. And that's what it's supposed to do. So, but today's Wednesday, so, it's not going to have, well, you've already made your money. So it's just not going to show big premium when I pop up the, the spread. But easy way to pick these and to make sure, TOS are going to calculate it right, okay? And you just click here, and so that's the 189.50, which is exactly what our calculations have demonstrated. So that's it. You just hit. It's that simple. You just hit the 189.50 right there, and bang. You can see you're going to sell the 189.50, and you're going to buy the 189. And the best way to make sure and check on this and to make sure everything's right is to just go to your if you're not sure which are verticals, just go to your singles, and what you want to do here's your 189, here's your 189.50. So you can see that's correct. So on your puts, you always want to sell the higher price strike, which is that 189.50, and buy the lower priced, because that's going to create your spread. So if picking the strikes confuses you, just go to your singles and look at the money. Look at the last price. Look at the bid ask. And you always sell the high, whether it's a put or call, always sell the higher priced option. So you'd sell the 189.50, you'd buy the 189. That's a 2-cent spread. Okay? And that's exactly as it reflects here. So on Monday, it would have been about 20 or 30 cents. If this is the only time I had to do the vid. So that's how you would set that up. And then you would just click your confirm and send. And, that would be your order. And that's how you would get your calculated levels and trade for premium income. And you just do this every week. And, you're looking for stuff with I'll give you a couple of hints. When you pick your spreads, you pick a low, sell about a 23 to 18, 19 cent option, and buy a lower price one, 8, 9, 10 cents or whatever, and that's going to be your spread. Because the deal is, it's very difficult for those 20 deltas to get into money. And because you're just trading for premium, I'm selling something at 20 cents, I'm buying something at 9 cents, you have an 11-cent premium there. So both options are going to expire worthless. When you enter the trade, it's a credit spread. The credit immediately goes into your account. And then the rest of the week is just monitoring the trade and watching that time decay just crush that delta. And when that delta gets crushed, it's hard for it to move into money. It's going to expire worthless. Because really, you're just trading the 189 strike. You're selling it, and you're just picking, the strike you buy for as the hedge, and that's to lower your margin. So that's the deal. You'd be selling the 189.50, and then you could hedge it, and you could hedge it with the 189, the 188.50, and change that spread a little bit to what you want and got comfortable with. Because the second one matters only for your margin. The option you're going to buy, use as the hedge, is there to lower your margin and lower your risk. So you can mess with that one a little bit. But the original one, the one you're selling, that's the strike price you don't want hit. And so that's the only risk. All you got to basically, you just sit there and make sure it doesn't get to 189. If it gets close to there, get out the trade. And you can see here Monday already, today's Wednesday, okay, it ain't moving that far. So both the options will expire worthless. You have the credit in your account. And that's that. So I hope you enjoyed and got something fruitful out of this. And I hope to do more of them for you.